So markets marginally lower today after a consistent winning streak for the S&P 500 on optimism that the trade war may not be that damaging. Our guest says look out for companies trading at a discount, including large tech. We're joined by Geranen, Chief Market Strategist at CalBay Investments. Great to see you. Thanks for joining us. You say you can't trade on tone, and that I think you mean by that optimism about Trump's next move. You're wanting to see hard data.
Exactly, and thank you for having me. Over the past month, we really have seen the markets moving on fear and leaked comments. And now we've actually seen a positive shift towards a more bullish tone, as well as some positive data, whether that be corporate earnings, as well as inflation data. So we are looking forward to some more to back that up. And ultimately, we'll see if the Fed decides to cut rates this week.
Is there a decent chance that the Fed will go that route?
At this point, we don't think so. We think the first cut, if we see multiple cuts this year, most likely in July.
Why would they not go now? Well, of course, there's lots of reasons why they should and they shouldn't. But again, I guess we've yet to see hard data on the economy.
Exactly. And that's why the Fed most likely won't move, is because with their dual mandate, both the inflation numbers and the unemployment numbers haven't been a big enough swing in order to put this first rate cut of the year. And so I think really the next one that we could see is unemployment start to tick up again. The Doge and federal government cutbacks haven't necessarily pushed the numbers into the range that we would maybe previously have thought. So I think either a bigger swing in government layoffs is going to have to happen in order for us to see a pullback.
On the Fed, you are relieved to see President Trump pull back from that position that he was apparently adopting with his threats to fire Jay Powell.
Yes, that was one of the positive tone shifts that we really appreciated over the past month, was laying back off of Powell, because from our point of view, the Fed's independence really is mandatory for our country's success moving forward. There has been talks about replacing Powell, but ultimately we're still in the camp that Powell has done a great job, and we look forward to the rest of his tenure.
Big tech, you reckon that for some of these names, the valuations are the best we've seen in quite a while?
They are. And at the beginning of this year, we did anticipate that there would be some turbulence through the beginning of Trump's presidency and some of the tariff policies. So while these tech companies were at their all-time high valuations, we anticipated that there would be sort of a restructuring. And we saw that. A lot of the large growth names, money came out, money went into more large value. And so it wasn't a surprise to us. We did a rebalance at the end of the year in anticipation of this. But after the tumultuous April that we've had, we definitely have seen the multiples come down to 2-3 year lows. So from our stance, with any fresh cash or dry powder that's available, it's a great time to take advantage of some of those opportunities, because it's been years.
That's interesting. What about, I mean, AI? It's a broad subject. Is there too much hype, though, out there?
So I think that was one of the reasons that also brought back these valuations, was when the Chinese-led DeepSeek was announced. Clearly, there was this scare that U.S. AI companies wouldn't be able to keep up. And I think something that investors were worried about was the capital expenditures of some of these large cap tech companies, and if they were going to pull back. But from all of the corporate earnings that we've seen and the market outlooks, that capital expenditure spending on AI has either stayed the same or increased. And so from our view, that's a strong bullish outlook for some of these companies, and we're going to continue seeing that until we see anything else.
What about bonds? Because in 2022, we had this alarming phenomenon of equities and bonds dropping. How are you looking at, say, U.S. government bonds right now? Maybe we'll put up a 5-year chart for the yield on the 10-year.
So we were obviously very concerned right after Liberation Day, and we saw the quick whipsaw of the 10-year Treasury. That brought back memories of 2022 when both bonds and equities were down double digits for the first time in history. Something that we did after Liberation Day was try to implement some alternative funds which helped reduce the correlation of our portfolios to the markets. And so what we did is we put that in, and now we're waiting for a time to get back into some of those traditional bonds and try to keep duration short. Because right now, with the outlook that we have, it is still murky, and so we are going to stay on the shorter end of that yield curve.
Clark, thank you very much indeed.
Thank you.
Clark Geranen has been our guest, Chief Market Strategist at CalBay Investments. Up now.